Hey everyone, Paul Clark here, and I just moved into a new apartment, and I feel like whenever you're moving, I feel like it always kind of makes you question or really kind of think about what makes sense, to be renting or to buy a place. And so I know that there's a lot of different ways that you can attack that question, a lot of different scenarios you can run, but I wanted to, in this video, walk through the difference between if you were going to just buy cash outright for a home or a house, or if you were going to instead use that money to invest and then use the investment proceeds to go ahead and pay your rent payments. So specifically, I'm going to be looking at a 20-year time horizon, and I'm going to say over those 20 years, what would leave you better off financially? Which scenario would leave you with a higher net worth? Owning a home that you pay cash for, or deciding that you're going to take that same amount of cash that you would have used to buy a home and rent, and say that along the way you're also going to be investing in dividend paying stocks, and that you're going to be able to use those dividend proceeds to pay for your rent payments. Now, I know again that when you're making that decision about whether to buy or rent, that it's not just as simple as boiling it down to just the pure math, because a lot of this depends on the lifestyle that you actually want to live. There are certainly benefits to having a house versus an apartment, and I think there's some benefits to having an apartment versus a house. So I'm going to start out with what I think are some of the benefits of actually having an apartment. So with an apartment, I think that it's something that you're not tied down to one area, right? That, if you decided that you wanted to live in a different apartment every one of those 20 years and move, let's say from Florida to California, Michigan, kind of bouncing around, right? You can do that without, incurring, large transaction costs and things of that nature. Whereas if you were actually going to say you were going to buy a home, and say I'm going to sell my home, in one state after living there for a year, go buy another house in another state for a year, sell it, move, and bounce around, right? You certainly can't do that. You don't have that flexibility, or at least you're going to be way, way worse off. So, and the other thing to consider with that, of course, is just that when you're actually buying a home, you're going to have more square footage. You're going to have something that's a bigger size for sure than what you're typically going to get for an apartment. So it's understanding those trade-offs. And, for some people, they could say, hey, if I'm able to rent for 20 years and say that, I'm able to travel more often, I can move around, without incurring those transaction costs. And oh, by the way, I'm perfectly happy living in, somewhere between 800 to 1,500 square feet, let's say, versus maybe getting something more substantial again for the same amount of money for a house. So there's, again, more factors than just the pure math. But what I want to walk you through is just the pure math, because I know a lot of people, when they talk about this question, they would say just absolutely outright that there's no question about it, that when you're paying rent, that the money is just going down the drain, you're getting nothing for it, and that, at the end of 20 years, with an apartment, you have nothing to sell, you have no assets, whereas with a house, of course, you have the house that was already paid off, it's still paid off, it's likely gone up in value, so people say, hey, this is a no-brainer, but I think it's a little bit more nuanced than that. I think it's more complicated, and I think the results might surprise you. So let's go ahead and get into the example. Okay, so when we start looking at this, let's look at the scenario first where we're going to be renting. So if you're going to be renting, again, the whole idea is that you're starting out with $250,000 cash. And again, you're trying to determine if that $250,000 would leave you financially better off by investing it and renting, or buying a home, paying cash, and living that way. Okay, so again, what's going to leave you better off? So in this example, we're starting out and we're going to say that we're putting in $250,000. We're putting that to work in the stock market immediately. And what are we going to assume? We're going to be assuming that we're putting this into stocks that are paying a dividend yield of about 3.5%. So meaning, for every $100 you have invested, you're going to get back in cash $3.50 payment from the companies. Now that could go, up or down in any given quarter or any given year, but we're just going to assume a straight average, just to make it a little bit more simplified. We're going to make some of the same assumptions from the actual home buying perspective as well. And then we're also going to assume that our actual value in our stocks themselves are going to be increasing by 3% a year. So when we look at this, we're going to say, your $250,000, your principal that you're investing in is going to be increasing by 3%, but you're also going to be getting a 3.5% dividend. That total return on an annual basis is, of course, 6.5%, which, is pretty conservative when you look at what the kind of broader market has been returning on average. So the S&P 500, the Dow Jones, you look at some of these averages, they've really been around 9 or 10% from a historical average when you look over a couple decades, like we're going to be looking at in this analysis. So again, I feel like that's really pretty conservative. So those are the assumptions there, and we're going to basically live under or work with the assumption here that the dividend is something that's going to be able to pay entirely for our rent. Well, if you had $250,000 invested at the end of 2020, then that would give you a dividend of $8,750. Now, if you divide that by 12, you can figure out that would allow you to spend $729 a month on rent. Now, I think that that's definitely a number that could be achievable from a couple different perspectives. I think that's achievable if you have a roommate, or certainly there are places out there where, in some markets where you can actually get yourself either a studio or a one-bedroom apartment for $729 a month, right? So we take a look at that, and then we just basically run this through and say that every year, there's our 3% growth in our stock fund there, so the price appreciation of 3%. We're saying that our rent is going to be able to, increase essentially because we're able to say that 3.5% of our dividends is now going to be yielding us $9,000 or $9,013 on an annual basis, or now allow our rent to spend $751 a month. Okay, and then we just go on all down the years. And the way this works, again, by assumption, is that we're spending all of our dividend income on rent. So dividends come in, rent goes out. So these numbers all add up straight to zero. Okay, so that's the first scenario. Now let's go ahead and take a look at the scenario of buying a home. So this one says, again, same starting point. You have $250,000. But now it's going to say that you're going to put that $250,000 straight into a house. So you find a house that you like, you spend exactly $250,000. We're going to assume that's fairly valued. And here I'm kind of actually being a little bit more aggressive with what we're going to allow the home value to increase by. And so I'm kind of on purpose trying to be conservative with the stock one, and then, a little bit more aggressive for the housing scenario, just to kind of prove a point here. But we're going to be assuming that the value of the home is going to be increasing by 4% every year. So the historical average for homes is somewhere around, 3.5%, 3.8. So again, stretching that a little bit to say that we're going to be able to hit 4% every single year. Now, we also have to look into the total ownership or cost of ownership of the home. And the total cost of ownership of that home, you have to remember, is going to have to take into account your annual home maintenance as well as your property taxes. Now, again, the property taxes is something that's going to be a little bit smoothed over time. So I'm actually recording this video living in Michigan, and our property taxes are about 1.6%. So that's the number I'm going to plug in here for the frame of reference. And for our annual home maintenance, I'm going to be assuming that it's going to be 1.5% of the home's value. And I'm going to assume that that's going to just be 1.5% of the home's value over the whole 20 years, just to kind of simplify that a little bit. And again, I think that's a fairly conservative number. I've kind of, really kind of read it that home maintenance can be anywhere between 1 to 5%, maybe 1 to 4%. So maybe somewhere closer to like a 2.5% might be kind of more of an average. So again, being a little conservative there. And then with the tax rate, I'm just, assuming exactly what the tax rate is. So now if we go back to unhiding all of these. Okay, so now we get both scenarios back. Now, all I've done is, you come down here and you say, okay, at the end of the 20 years, so if you take yourself to 2040, the value of your stock portfolio that you started out with $250,000, increasing by 3% every year. Again, that's the straight average. What you could really imagine is that there's some years that are going to be down a little bit, some years are going to be up a little bit more, some years flat, right? But on average, expecting a return of about 3% a year. That's going to leave you with a final stock portfolio value in 2040 of over $450,000. And then, of course, we have over the 20 years, we have the realization that we've spent $250 on rents, and then our average annual rent per month there. So just our average monthly rent, I guess, is an easier way to say that, is $996. And that's just saying how much do we spend on rent per month on average over these 20 years. So pretty close to about $1,000. So you spend about $250,000 or just a little over in rent. But good for you. You've also been able to collect over $250,000 in dividend payments. So those exactly net out. So here you're left with a total value of $451,000 rather. And so now let's take a look at the table over here to see how you did with your home ownership. So here we again have decided to say that our home value is actually going to be at the end of the 20 years. So with our 2040, we're going to say that our home is increasing by 4% every year. And that's left us with a home value of $547,000. So from the home value alone, you can see that yes, your home value is actually assumed to be higher than the value of your stocks alone. But that's not the only cost, or not the only financial consideration that you have to give. You also have to add up all of those home maintenance costs. So over those 20 years, every time the furnace went out, every time the roof needed to be replaced, or every time you needed to call an exterminator, all of those home maintenance costs, the things that are expected and the things, of course, that were unexpected, would need to be taken into consideration. So over the course of those 20 years, you spend just shy of $120,000. Or per year, on average, you're spending about $10,900. So we see up here, just averaging those costs there. Actually, our average, let's fix that formula. The average home cost is actually going to be $5,709. There it is. And then from our top property taxes, let's make sure that that was copied over correctly. Let's do that. That sounds better. So our total property taxes, we're going to be looking at $127,000 that we paid out over those 20 years. And so when we actually look at the sum of those things, right, that adds up to $247,000 that goes out of the pocket, right? So those are real expenses that you have to take into account. So when you subtract those off of your home value, you're left with $300,000. Because again, remember, when you're over here talking about the rent side of things, if there's a roof that needs to be repaired, if something happens, whatever it might be, it's going to be covered, and you don't need to worry about it on this side of things. Those break fix you do need to worry about on this side of things. So, there you have it. That's one perspective, one way to look at this. I think, you could also look at this, multiple different ways. And I think in a future video, I want to kind of look at this, not just from the perspective of paying cash versus investing and renting, but maybe it's a matter of, hey, how does this analysis change if you were going to put, let's say, of the $250,000, 20% down or 10% down, and then, pay the mortgage and then invest the difference from there. I mean, what situation is better of those three? But wanted to start out talking about these two, just pretty simple, paying cash for a home, or deciding to invest and then using the dividend income to pay for rent. So I'd love to hear what you guys think of this. I know that, this kind of simplifies things, or maybe potentially oversimplifies things. So if you guys think that this was actually useful, is meaningful, let me know. If you have any holes in the kind of methodology that I've kind of laid out here, again, let me know in the comments below, and love to hear your input. So thanks for watching.